Well, good evening and welcome to this live stream on the 4th of October 2022. Martin North from Digital Finance Analytics here. Great to have you on, and thanks for taking some of your Tuesday evening. I hope you didn't get too much caught out by the the hour change. We've sort of sorted it out now, but Queensland is 1 hour behind, and of course the West, well, they're a world of their own now. So great to see you all here, and lots of things I want to explore with you tonight. As normal, what we're going to do is to do the show in sort of two halves. The first half will be a bit of a presentation and discussion about some of the data. The second half will be Q&A, and I've also got my postcode engine online if you want to explore specific postcodes. So without further ado, why don't we get on with the show? And as always, let me just start with the house rules, because it's worth just underscoring we don't provide financial advice or legal advice or property advice on this channel. It's just a general conversation. We do moderate the chat, so just bear that in mind, please. As at the 4th of October 2022, if you're watching this in replay, if you want to get my attention, use @Walk the World to make sure I see your question in the chat. And I've enabled Super Chat if you want to get your question to the top of the list. And the other point there is if you'd like to make a contribution to what we do, always greatly appreciated. And let me just, before I go anywhere else, let me just take you through three quick announcements, parish notices. Firstly, if you've not signed the petition relating to the regional bank closures, there's still an opportunity to do it. I made a show about this yesterday. As at last night, we got 3,993. I now know we've got more than 4,000 signatures already. And so if you've not signed the petition, the link is in the comments below. And the point here is that we need a proper conversation with the Parliament about regional banking and regional bank closures, because the report they produced just the other day was rubbish. So this is a way of making sure that Jim Chalmers has to respond. So if you've not signed the petition and would like to, you've got a couple of days. The close of play is the 6th of October. Second one to talk about is on the 19th of October, we've got a session in Melbourne with Nucleus Wealth, Macro Business and myself, and there we're going to be talking a little bit about what's been going on. You'll be able to meet the team with Nucleus Wealth and MB. I'll be joining virtually. It's in the evening, and again, the links are below if you'd like to sign up for that if you're in Melbourne. It's an early evening event. And the third one, on the 9th of October, I'm involved in an online seminar including Harry Dent, Robert Kiyosaki, Peter Schiff, Gerald Salente, be hosted by Greg Owen, and it'll be 10 a.m. Sydney time on the 9th. And again, the link is in the comments below if you'd like to sign up for that. It's free, and it's going to be a very important conversation about where the market's heading and what it all means. So you know what Harry's going to say, you probably know what Robert's going to say, you probably know what Peter's going to say. As for Gerald, well, he's got some very good views, and you know what I'm going to say. But anyway, if you'd like to come along, there's a link below on the 9th of October. Okay, now let me just come back to the situation, because I think it's probably worth just doing two things. Firstly, I just want to make the point that, daylight saving changed. So a few people have been caught out by that. Changed over the weekend, so we're now an hour different, certainly in Sydney and Melbourne and places like that. And you know that the RBA announced the change to the cash rate up by 25 basis points today, which was lower than expected. And there were some significant movements on the markets as a result of that, just in terms of the Aussie dollar. So let me just roll this back a little bit. So you can see here that it basically wobbled down, wobbled up, and it's sort of come back. We're at about 65 cents, and that's pretty reasonable, bearing in mind where we are. But the ASX in Australia was up quite considerably, up 3.75% today. A lot of that, though, was not just the announcement at 2:30, but also the fact that there were significant events over the weekend. And I'll talk about those in a bit as well, it is worth noting that some of the bond rates have changed. So the 2-year dropped a little bit, and the 10-year actually is a little bit lower, but that was lower predominantly because of the other announcements, not just the cash rate change. And internationally, I'll just show you a couple of the other bond prices that are quite interesting, because things are moving quite quickly. Again, they do seem to have this bit of a thing going on at the moment. So if you look at the 30-year in the US, it actually dropped. It's now down to 3.653. Now that's because of information that came out showing the manufacturing index in the US was weaker than expected. So that means that people are now starting to talk about Fed pivots again, and maybe they won't put the rates up so high. And the 10-year was also down as well. And of course, the other thing is that the UK also pedaled back on their tax cuts, and that had a significant impact on the interest rates. So the 10-year in the UK is down to 3.8 now. Last little while it was up at 4.5, so that's a big drop down. And that, of course, had significant impact on mortgage rates and stock markets and all those sorts of things. So, in fact, there's been another pivot in the UK. So they've now announced that the budget is going to be looked at by the Budget Office of Responsibility, the OBR, which means they're going to actually look at the data before early November, which is when they were talking about doing it previously. So there's a bunch of stuff going on there. Now, next thing to talk about is this. This is the latest credit data. This came out today. The value of new loan commitments fell in August after a fall of 8.5% in July. It was 3.4%. And it's interesting that the investor new loan commitments fell more than the owner-occupier ones. Also, the new homes lending was down, according to the HIA. They basically said it's down by 15.4% on 3 months earlier. And they're saying that if this trend is sustained, which is expected, then the 2.25% increase in the cash rate so far will have brought this pandemic building boom to an end. You can see that it's come back to where it was. Also, refinancing is extremely strong, though. So whilst new loans are down, a lot of people are still refinancing. The total housing rose 5.3%, which was 9.8% higher compared to a year ago, with owner-occupied housing 2.8% and investor housing 10.9%. So people are trying to get onto lower rate mortgages, which makes sense because a lot of people, of course, are essentially in the situation where they're paying more than they should for the loan they've got. So shop around if you can is still quite sensible. Loan sizes are falling, and that's another interesting observation. Nationally, it was down from 609 to 589,000. Largest fall, New South Wales. There's a surprise. And that's, of course, simply because the borrowing power has been reduced. Just slightly rising in 2 territories, but statistically not important. First-time buyers just slightly up, but still significantly down from the peak. South Australia fell 1.4%. There were some rises in other states. And the building approvals were a little higher, but it's very volatile, of course, and it's particularly the high-rise that are volatile because what happens is that, of course, when you have a high-rise block, it's lots of units, so it comes up and down like a yo-yo. But the trend estimate fell 0.2, following a 0.4% rise in July. So there's not really a lot of good news there. And interestingly, the AFR today reported that foreigners are liquidating more Aussie mortgage bonds, and that's putting a lot of pressure, particularly on some of the securitised borrowers, lenders I should say, particularly those that are non-banks. It's interesting that some of that's being forced by what's happening overseas with the bond rates. Now, if I just quickly talk to my model, of course, you understand the model if you've seen the show before, but just for those who haven't, we run surveys and do a lot of other modelling. We have data coming in every week, and then we slice and dice the data different ways. And that allows us then to look at some of the scenarios and come up with a view as to what prices may be doing, looking at stress, the trajectory, the buying and selling intentions, migration, core market model, takes all that, runs it through the scenarios, and we then come to a view of where the scenarios may be over the next 3 years. And that's quite granular information down to a postcode level. I also, of course, still run my one-to-one service, and if you want to chat about a postcode in particular or a suburb in particular, I can't give financial advice, but I can, of course, talk about the stuff that I do, look at the stress, the home price trend data, and you can have a conversation with me up to an hour by Zoom or phone. There is a fee involved because of the work involved in pulling all the information together, and we're booking 3 to 5 weeks ahead. The link is below if you want to sign up for one of those. Now, let's look at the RBA. So the RBA, the board decided to increase the cash rate by 25 basis points to 2.6%. And it increased the interest rate on exchange settlement balances to 2.5%. That's the money the RBA is paying to the banks for all that term funding facility money that they parked back at the RBA once it was given to them at very low rates. So that's very helpful of us taxpayers to support the bank's profits directly. It says that the assessment based on the inflation and economic growth for Australia thought the cash rate of 25 was right. Inflation's too high. Yeah, we know about that. They expect a further increase in inflation, and the bank's forecast is for 7.75% over 2022, so still higher than where we are. A little above 4% over 2023 and around 3% over 2024. So believe that if you want. And they went on to say that wages growth has continued to pick up, I would say patchily. Consumer confidence has fallen and house prices are declining. But then people are finding jobs, gaining more hours of work and receiving higher wages. Gaining more hours of work is another way of saying doing more work, doing more jobs to try and pay the bills. And those higher wages are not equally spread in my view. And they said the size and timing of future interest rates will continue to be determined by the incoming data and the board's assessment of the outlook for inflation and the labour market. They have changed the wording a little bit here, and I don't want to get into micro-mining their words, but what they basically say is that they are going to do again. Now, I have to tell you that I'm very disappointed that they've done this. I think it's a mistake. I think that our inflation is still quite high, so it's above 6%, and that's quite similar to the US or New Zealand. The UK is a little higher. But, interest rates in those other places are a lot higher than what we've got. So we're not actually responding appropriately. And, of course, the reason is because of the property market. We're so leveraged here. And that's one of the reasons why I think they've done what they've done. And also the fact that because it takes time for the rate flow to change and flow through into individual households, about 3 months on average, they're waiting to see what happens. And I think also they're going to wait to see what happens with the Fed, maybe even the midterms, and other things too. So I personally don't think this is a pivot. I think this is just a pause or a slighter rise, but rates are still going up, which means that Westpac, for example, and other big organisations will likely lift their rates. NAB has already announced that they're going to pass the lift right the way through to everybody already. So it's already hitting the newswires now, which means that you have to post it out, allow a month, so in a month or two this will flow through to existing borrowers. Of course, the fixed rates, no, but variable rates, yes. So that's the story with the RBA. Now, just a few other things that it's worth looking at. This is actually the house price data from CoreLogic, and they showed that Sydney fell, Melbourne, Brisbane fell, even Perth and Adelaide fell a little, and both the combined capitals and regionals fell. The capitals more than the regions. So home prices are continuing to grind lower. And bearing in mind that there's a lag of perhaps 2 months to this data, we would expect to see more falls ahead. Now, are there more hikes coming is the interesting question. Now, this was done before the announcement. So ANZ and CommBank and NAB and Westpac are all here. Only one of them, CommBank, called 25 basis points today, and they're calling 25 basis points again next month, whereas the others were calling 50 this month and 25 next month. So it begs the question, will they do 50 next month? And I'd make the point that ANZ was looking at a terminal rate of 3.35%, Combank at 2.85%, NAB at 3.1%, and Westpac at 3.6%. And interestingly, Westpac has come out this evening and said they still hold to that 3.6% terminal rate for the rate rises, but it's now 1 month later because they think that the RBA will just to do it in a little bit of a staggered fashion. Now, it's worth just looking on the 30th of September. The implied rate was 4%. It's come back a little since then, and I'll be updating this chart in my next show. But there's still more rate rises to come. And it's also worth making the point, of course, that the expectation, this is from CanStar, of higher rates means that the future rates are going to be considerably higher from where they were. And in fact, this was data that CanStar put together on the assumption that the rate was going to be another sort of significant move, not quite as high, but nevertheless, the monthly repayments are going to be higher than they were. Now, let me move on to stress, but before I do that, I'm just going to have a look at the chat and see what else I can deal with, and maybe get rid of a few of the rubbishy comments that I see there. Bye-bye, channel. Okay, and let's have a look. Yeah, I think James put his finger on it quite nicely. The West is broke. Crony government has resorted to vaccine racketeering. Yeah, well, you know, it's not good, not good, not good. And again, government offering higher interest rates because they squandered $1 trillion. Yeah, the debt is the problem. There's too much debt in the system. And as I tweeted the other day that there's this massive dilemma, right, which is, do I try and handle inflation and really squash inflation, or do I pivot and do more quantitative easing and those sorts of things to try and support the economy and house prices and everything else? And of course, the Bank of England is a classic example where they're actually done quantitative easing in the short term to save the bond market, the $1 trillion bond market in the UK, long-term bond market. But nevertheless, they're also talking about quantitative tightening late October. And they're also talking about raising interest rates. So you can see that there's a real confusion amongst the central banks as to what to do. Now, what else can we see here? If you've got questions, don't forget to put the Outwalk the World in there and we can get back to it. Luke says, we can't harm the property bubble. Well, the property bubble is already imploding to some extent. The question is, how much more will it implode? Remember of this issue of the flow in of higher rates takes time to work through. Actually, the research from central banks around the world is that raising rates, you don't see the full effect until about 18 months later. So we'll see. I suspect that there's more to come. And James says they use chicken bones, tea leaves and the dartboard to set interest rates. Yeah, I suspect that it's not as scientific as that, but I could be wrong. Jackie asked, do you think Australian banks may face a bail-in situation like we might see with Credit Suisse? Well, I'm not sure Credit Suisse is in too much of a crisis. I mean, there's a lot of stuff over the weekend, and of course David Taylor put out his Twitter, which set the cats running, and by the way, he had to take the Twitter down later because it contravened ABC policy. The truth is that Credit Suisse is being reconstructed at the moment, and they're going to announce a new strategy, and the CEO has talked about building from the phoenix, phoenix from the fire, from the ashes as it were. But they do have issues with their credit default swap rates, which are very high at the moment, and there are some risks there. But I think more generally what I'd say is that a lot of these large investment banks have taken quite extreme positions, and now the markets have moved quite dramatically. So the question will be, what will be the fallout? Now, whether that translates then into a need to grab capital, and whether in fact that grab of capital could encourage some other banks to, for example, think about bailing in. I don't think in Australia at the moment we're close to that, looking at the data. But you never say never with those sorts of things. And of course, there is the app review that we don't actually have active bail in Australia. And we do in New Zealand, of course. It's absolutely transparently clear there. But in Australia, the APRA guys have said consistently, we will never do it. It's not on the agenda. Well, we'll see if things get really sticky. But what I can say is that it's clear to me that banks' margins are being squeezed. They're being squeezed competitively. And they're also having funding costs going through the roof. And those securitization measures that I mentioned earlier on, where people are actually buying those, trying to sell those securitized bonds back, means that there's actually some issues on some. Another point that's interesting, that some of the real estate trusts are also finding it a bit tough. And in the UK, some of the real estate trusts have actually stopped paying down anybody who wants to liquidate their trust funds. That's a concern. That's another indication of significant issues in the system. So personally, I don't think bail in Australia is an immediate risk, but we will see. There's an interesting little question. I like this one. I'm done with houses. Where do you honestly see the price of caravans out going? Well, actually, there are a few caravans being listed at the moment. So people are having to sell some of the toys, including caravans. So you might be able to get a well-priced one. And Kevin says it's going to be a great Christmas for some. Yeah, not for many, I fear. It's clear that the situation is getting quite difficult for many households, not just here but around the world. And of course, we've still got the international backcloth of the conflict in Ukraine, the fuel prices and all those things, and the price of gas. And by the way, I will just mention that whilst we got some relief with regard to gas because of the supply was confirmed recently by Albo's government, they didn't confirm the price. So effectively, we locked into paying full market price for the gas that we can get, which is a problem. Now, they're talking about potentially doing other stuff, but I think we are being taken to the cleaners here with very expensive energy costs, which means that the gas price and the electricity price will be very high, particularly down the East Coast. Of course, the West, not so bad. Okay, let me just go back then to the stress, and I'll just quickly recap, because not everybody understands how I define stress, and it's really important. There are many different definitions, from 30% of income or taxable income through to underwriting metrics that some use, but I define it in cash flow terms. And if households have more outgoings, excluding the one-off discretionary items than income, then we define them as stressed. If they have a mortgage, they're in mortgage stress. If renting, they're in rental stress. Investors with cash flow pressures are identified as stressed investors. And I will also aggregate the data to estimate total financial stress as well. And we express each as a percentage of household and a count. I use the count as a better metric. The reason I do that is because you could have a small postcode with a very small number of households that are stressed, and that will give you a very high percentage. But the question is that representative of what's really going on? So I tend to go for the count of households rather than the stress percentage. And then if we look at the data, now this is as at September, and this is including all of the new census data and everything else that's up to date. So the first trend to note is that the rental stress has shot up. So we've seen this very strong acceleration over the last 2 or 3 months, and now it's at 61% of those in rent. That's huge, and that's a worry, and I'll talk about that more in a moment. The mortgage stress is sitting at 45.2, just below the 46% we had last month. Now, there's a reason for that. First one, some people have refinanced. Secondly, we did get some low income. We did get some income improvement for some of the low-paid workers. That's now embedded. And thirdly, there were a few pay rises and things. And people are also shopping around for cheaper mortgages. So all of that's part of the reason why it's come back just slightly. But it's still very significant and still, frankly, worryingly high. And just to remind everybody that the household debt-to-income ratio is 187.2. Now that, of course, is the RBA figure, and that includes all households and small businesses, not just those borrowing. So to get to a real figure, you need to multiply by 3. So that means it's 5.5 to 6 times average income, which is pretty shocking. Now, here is the stress data for September. And I'll just start by showing you the grand total in mortgage stress is 45.19%. The rental stress is 61.62%. 20% of investors are in difficulty and 43% of households overall across all those categories are in financial stress. It does vary by different states. So you'll see there that the movements up shown in yellow, South Australia went up, Western Australia went up, and the other states dropped back slightly. Now that's really the function of that refinancing that I mentioned a second ago. If you look at the rental stress, you can see there that the highest rental stress is sitting in New South Wales, then the ACT, and also at 60% in Victoria, Tasmania, and Queensland. Investor stress is highest in New South Wales, and little problem in the ACT too. And overall financial stress is highest in New South Wales and the ACT, Victoria and Western Australia following up quite closely. Stress is lowest in South Australia. And just in terms of numbers, 1.7 million households are in mortgage stress, but 1.9 million are in rental stress. So that's a huge number, and that's a real problem. If we then look at the information by segment, and again, I've highlighted those there, and I've highlighted those in this particular chart with the highest numbers. So as you see, battling urban and young growing families have the highest amount of mortgage stress. Rental stress is highest among older households and also among first-generation Australians. They're called the multicultural establishment, and also wealthy seniors as well as young growing families. And investor stress is more predominant in the exclusive professionals, the more mature, stable families, and also the young affluents. And the financial stress, well, it's spread quite widely, but young growing families is where a lot of the issues are, 64%. That's where a lot of the first-time buyers are, of course, as well as 53% amongst the battling urban, the people on the outskirts of town, and the disadvantaged fringe. And I would make this point again, the first-generation Australians are actually very much exposed too. Now, if we then look at mortgage stress, we can see here that the postcode with the most mortgage stress is 2560, which includes Campbelltown, with 12,000 households in stress. Then we go to another New South Wales postcode, Chipping Norton, 2170. That includes Liverpool, Liverpool South, Mount Pritchard, Warwick Farm, as well as Chipping Norton, with 11,300. Then we go up to Toowoomba in Queensland, 4350, with 11,200. Then we go across to Western Australia to places like Hocking and Wanneroo, with postcode 6065 and more than 10,600. Then we come back to Victoria, and that's Hoppers Crossing, places like that, 3029 with 10,300. Another Victorian postcode, Craigieburn, Donnybrook, Roxburgh Park, Victoria, 3064 with 9,700. And I'll make the comment here that this is a significant change because of the new property that's been brought in through the census. And then we go to Western Australia, to Sampson and places are there, North Lake and O'Connor, Spearwood, 6163 with more than 9,500. Back to Victoria, Berwick and Harkaway, 3806 with 9,200. Then we come back to Marsden Park, Box Hill, Berkshire Park, 2765 and with more than 8,900. And then down to Victoria, Narrow Warren, Fountain Gate, 3805, more than 8,900. So you can see that there's a commonality here. A lot of these places, a lot of these postcodes are actually high development, new postcodes, where there's been a lot of new building, a lot of people essentially moving in, first-time buyers specifically, a lot of first-generation Australians also moving in and taking properties out at the peak with very large mortgages. Some of them also used the homeowner grant schemes, and also the government gap between 80 and 95%. So they've got 5% equity. So all of those things are in those places. That's where a lot of the pressure really stands at the moment. If I quickly run down rental stress, Victorian postcode 3000 still is at the top with 13,300. Then we go to Toowoomba with more than 10,000. Then we go to 2170, including Liverpool, with 9,200. Then we go up to Queensland postcode 4215. That includes Southport and Labrador with 9275. Then we come back to Campbelltown, postcode 2560 at 9,100. Then we go to Mount Druitt and Lethbridge Park, places like that, with 8,900. Then we go to Queensland, Mount Warren Park, and a whole bunch of other places there. Postcode 4207 with 8,800. Then Upper Coomera, 4209 with 8,450. Then we go to Hoppers Crossing in Victoria, 3029 with more than 8,300. And then Zetland and Waterloo, 2017. So you can see a new portfolio of postcodes here because of the recent additions of new properties being built and let. Then if we go to stressed investors, Melbourne is right at the top, not surprisingly, with 4,200. Then we go to Wentworthville and Westmead, 2145 with 3,500. Then we go to Mount Claremont in Western Australia, 6010, 3,300. Then another Western Australian postcode, Beckenham, 2968. And then we go to New South Wales, 2065, which includes Crow's Nest, Greenwich, St Leonard's, 2,770. Then Hornsby, 2738 on postcode 2077. And then we go to Service Paradise, Main Beach, Isle of Capri, etc. up in Queensland, 4217 with 2,718. Then St Kilda in Victoria, 3182 with 2,658. And then Newstead and Fortitude Valley up in Queensland, 4006. And so it goes on. Lane Cove in New South Wales in the next category, 2066 with 2,468. And then back up to Queensland again. So you can begin to see that there are some significant areas. I'll also make this one last highlight, and that is Surrey Hills and Darlinghurst in New South Wales, 2010. And that's got 2,400. So that's a more developed area, traditional area, and yet there are still stressed investors there too. And then finally, if we look at the overall financial stress, Toowoomba is right at the top of the list. Then we've got Campbelltown. Then we've got Liverpool. Then we've got Hoppers Crossing. Then we've got Craigieburn and Roxburgh Park. And then we've got Melbourne. Then we've got Cranbourne. And so it goes on. So you can see there's a bit of commonality, and even places like Point Cook and Derrimut in Victoria, as well as Tapping in Western Australia, and also Wentworthville and other areas in New South Wales. So that gives you a bit of a feel of what we've seen. And the point here is this is now the most recent data we've got. It includes all the latest census data, all incorporated now in the model. And so it gives us a very up-to-date point of view. Now, having done that, what I'm going to do is now see whether we want to do a few postcodes. So I had a couple of questions earlier on, and I'm going to do those first, and then I'm going to look up and see whether there are other postcodes you'd like me to also show. Because, of course, what I can do is I can display the detailed information for the particular postcode and give you a bit of a sense of how it looks. Let me just get this sorted out. Stress source, make sure that's working right. Okay, so if I now do this, okay, wrong. If I do this, right, now this is now the model, and I just want to highlight some of the things I've got in the model because I've done a lot more work on it. So we start obviously with the postcode, and then we've got the household count. This is based on the census, and it's split between those owning outright, borrowing and renting. Then we've got those in stress, mortgage stress, rental stress, stressed investors, and total financial stress. Then we've got some price scenarios, And we've got scenarios based on best, base and worst, and I'll talk about those in a moment or two. We also have taxable income information from the ATO and from the household census. So the individual ATO data is per household individual. The household census data is income per household. And then we've got over this side the property profiles, which includes the houses, units and other, the mix, the people ratio, the ratio of people to properties, and also how many were vacant on census night, both in percentage terms and in number terms, and also the gross investment yield and the net investment yield. And then finally, we've got the disposable monthly income, and then what proportion on average is going to a mortgage holder. So this particular one, it's 36.7% of the disposable monthly income going on the mortgage of $2,340, and rental, 34.7%. So that's how we do it. And we have that for pretty much every postcode in the country. There are a few small ones where we don't actually have the full data set because the sampling is just at 0.5%. So there might be a few postcodes within, not that are so small we don't pick them up. We certainly pick up the main ones. And that information is the sort of information that's available via the Patreon program. So if you want to get information for all postcodes, you can do that. So with that, let me start by just doing postcode 3850, which was one that I was asked about before the show started. So 3850, and that's Sale in South Gippsland. So in this particular postcode, 6,500 households, and 33% own outright, 33% borrow, 33% rent, very evenly split. 56% of households in mortgage stress, of those borrowing, 50% of those renting in rental stress, stressed investors 22%, and households in financial stress overall 40%. Now here we have the three scenarios, the best, base and worse. And what I might just do is just to give you a bit of a flavour of what best, base and worst means before we go on, because it's quite important. So the best scenario says rates going to stay around 2.5% and fall next year. Inflation eases ahead of the RBA expectations. Wages rise fast. No recession in Australia. The base scenario is that rates rise by 3.5%. Rates rise to 3.5%. That would mean mortgage rates somewhere between 6 and 7%. They stay high 2023. Inflation stays above target until 2024, but no recession in Australia. And the worst case scenario is rates rise to above 4%, which is where the bond market was talking about the other day. Mortgage rates close to 7% or more, and they're going to stay high into 2024 along with inflation. Wage growth stalls due to recession and rates fall later. So the point is our scenarios are very much driven by the expectation of interest rates. So with that introduction, you can see here that the best case scenario for houses is around a fall of 8% over the next 3 years. The base case, 32% down. This is cumulative. And the worst case, 51%. Whereas for units, down 5, 23 and 38% over the different scenarios. One of the reasons why that's different is because houses shot up much more than units over the last couple of years through the government stimulus programs. And if we look at the property profile, 85.6% of houses, 6.4% of units, and 8% others. And the people ratio is 2.06. So basically, the higher the ratio, the bigger the bigger the average family block. In some postcodes, they're significantly lower, but below 2. There were 9.8% vacant in this postcode, or 670, on census night. Now that could be because it was perhaps holiday accommodation not let during the middle of the week on census night, or maybe some other reason. Gross investment yields 3, net investment yields minus 0.5. So underwater on a cash flow basis, many property investors are. And then if we look at the income, the average taxable income in 2021 from the ATO, $76,000. The average household census income is $69,000. And looking at the disposable monthly income, $4,758 on average, does vary of course, but it's an average. 32% going on the mortgage, at 1,560 and 29.3% at 1,395 going on the rent. And the charts just show the different scenarios there, so you can see it graphically as well as in the table. So there you go. That's how we do it. Now, if there are other sites that we want to look at, let me just get rid of this rubbish here. I have to say that it's getting a little bit annoying, but there you go. We'll get rid of some of those. There we go. Now let's just see what we've got. Okay, Stripy Cat says, here's one for you. 3977. So let's put 3977 in. Okay, and then I push this button here and I get rid of that so that you can see it. Okay, so this is Cranbourne, which of course is one of those that I featured in the analysis. So 38,600 households in the postcodes, 14% own outright, that's very low. 61% are borrowing, so you can see just how big the mortgage burden is. 24% are renting. And 29.9% or 7,000 are in mortgage stress of those borrowing. 80% of renters in rental stress. And 44% of households in financial stress overall. The scenarios are best case a fall of about 8% over the next 3 years. The base case down 32, the worst case down 52, and units down 6, 24 and 38. Looking at the property profiles, 87% are houses, 1.4% are units. The 10.8 on others, that includes those over shops and other industrial and also other tenants of temporary accommodation. So that could be, for example, people in caravan parks or cabins as well. Population ratios, 2.95, that's quite high, so that was significant, quite a few families. And vacancies were 3.9% or 1,479. Gross investment yield, 3.4%. Net investment yield, completely flat. Looking at the taxable income, 67,000. Average household income, 98,000, so almost always more than one person's working in the family. And the disposable monthly income, 5,614 on average. Typical borrowing on a mortgage at 40.8% at $2,288, and 33.7% on the rent at $1,894. All right, let's look at 2017. So that was one that was asked for. 2017. Okay, so this is Zetland, and again, that was on my list, I think, earlier on. So Zetland is 14,900 households, 6.1% own outright, 20% are borrowing, and 73% are renting. So a lot of people renting in that area. And the stress levels are very high. 55% of those with mortgage stress, 76% of those in rental stress, 57% of those stressed investors, and 80.5% overall households in financial stress. From a scenario's perspective, because of all this pressure, the best case is a fall of about 16% over the next 3 years. The base case, a 40% fall. The worst case, and that will be extremely severe, down 60%. Units down 12, 30 and 43% respectively. Now it's worth noting that because most of the properties in this area are units, 91.7%, only 0.4 are houses, and 7.9% are other types, including those over shops. The population ratio is much lower, 1.62, so that would include a lot of small family units or sole occupiers. But 14.8% were vacant on census night at 2,466, which is horribly high. And the gross investment yield is 3.2, the net investment yield is 0.3. Average taxable income, 90,700. Household income on average, 109,000. And looking at the monthly disposable income, around 7,745. Borrowing, 40%, 3,120 on the mortgage, and 37% or $2,866 a month for renting. And just to explain, this is based on the census data, and I've updated the repayment slightly to take account of the interest rate moves that have happened since. All right, let's see what else we can find. Yes, 3690. We'll give that one a go, shall we? 3690. Okay, 3690, here we go. Okay, 14,600. This is West Wodonga. 28% out outright, 35% borrowing, 36% are renting. 56% of borrowers in mortgage stress, 60% of renters in rental stress, 25% stressed investors, and 48.1% households in financial stress. And scenarios are down cumulatively 9% best case scenario for houses, down 33, down 53% base and worst. For units, down 7, 24 and 38. Most of the properties here are houses, 87%, just 2% are units, and 10% are other types of property. The people ratio is 2.21%, and 6.5% or 970 vacant. Gross investment yield 3, net investment yield minus 0.4. The taxable income from the ATO, $68,000. The household census, $72,800. And the disposable monthly income, $5,000, 33.2% on average going on the mortgage at $1,662 per month, and 28.4% or $1,420 going on the rent. So there you go. It's a bit of troublesome statistics there, I think. Let me just have a quick look over here and see what else we've got. Okay. Victor said 2039. Thank you, Victor, for the super chat as well. Appreciate that. 3029. Sorry, 2039. I get those. 2039, which is Roselle. Smaller account, 3,819. 23% own outright, 35% borrowing, 40% are renting. There's no mortgage stress to talk about, but a lot of rental stress, 66%. Stressed investment is definitely a problem, 41%, and 45% of households in financial stress. So overall, a fall of 8% best case scenario for houses, 32% base case, 53% for worst case scenario. For units, down 6, 23 and 38 for best, base and worst. And 24% are houses, 34% are units, 40% are other types of property, including those over commercial property, etc., etc. And the people ratio is 2.02. There were 10.5% vacant on census night, 421 properties, and the gross investment yield was 3.3, the net investment yield was 0.1. Average taxable income, 139,000, according to the ATO. Average household income, 166,000. Translates to disposable monthly income around $10,000, but 41% on average is going on the mortgage, $4,200. 31.6% or $3,240 going on the average rent. And Priya has asked for 4035. Thank you for the super chat. Really appreciate it. 4035. This is Albany Creek in Brisbane and Moreton. 9,900 households, 32% owning outright, 51% borrowing, 16.5% renting, and 43% in mortgage stress, 60% in rental stress, investor stress a bit lower, so you have 36% overall. As a result of that, the best case scenario for houses is up 4.3% over 3 years, the base case down 19, the worst case down 39. There are hardly any units there, so I'll just leave that. 86% of properties in the area are houses, 12.8% are other types of property, and the population ratio is 2.73, so that's more families. 3.9% vacant on census night at 383, 4.6% gross investment yield on average, net investment yield, which of course is after all the expenses, 1.4%. And looking at the income, $92,600 from the ATO. Taxable income, average household, $127,800, and the disposable monthly income, $7,214, with the average mortgage, $2,600 at 36%, or $2,333 for the rent at 32.2%. 8.5%. So there you go. That's hopefully some useful piece of information with regards to some of those postcodes. Now we'll see what else we can find. Nigel Fox wanted 820. Now I must tell you that some of the Northern Territories are a problem because the census and other data is pretty low, but I do have data for postcode 820. Here it comes. Okay, so there's 8,000 households in this postcode. 15% own outright, 26% are borrowing, and 58% are renting. And the stress is pretty low, actually, in this particular area at the moment. 27% in mortgage stress, 15% in rental stress, and some investor stress, but not a lot. So the scenarios are best case 6% over 3 years for houses, down 17%, base case down 37% for houses. For units, best case 4.6%, base down 12 or 27% for worst case. And looking at the distribution, 32% are houses, 44% are units, 23% are others, and the population ratio is 2.13%, 11%, 932 properties vacant. And the gross investment yield is 5.3, the net investment yield is 1.9. Income-wise, $91,400 from the ATO and $120,000 from the census per household. Disposable monthly income, just over $8,000. Typical mortgage, about 30%, $2,444. Typical rent, 24.7%, $1,993. Okay, and Siddharth asked for postcode 4022, which we can do. Thanks for the super chat. So this is Rothwell, again in Brisbane and Moreton. 2,991 households, 29% owning outright, 29% borrowing, 41% renting, 80% in mortgage stress, 78% in rental stress, 33% stressed investors, and 60.9% overall. And the scenarios are down 4%, best case over 3 years, base case down 28%, worst case down 48%. And the story is most are houses, so 69%, very small number of units, and 27% other types of property. And the population ratio is 2.39, and the vacancy was 3.9%, or 116 on census night. Gross investment yield 4.3, net investment yield 1%. Monthly disposable income is $4,718, and 42% on average going on the mortgage at $2,000 plus, and 40.1% going on the average rent at $1,894. Daniel T asked for 6051. Thank you for the super chat. And this one's 6,700 households, 16% own outright, 33% borrowing, 49% renting, 26% in mortgage stress, 62% in rental stress, and overall 47% in financial stress. Scenarios down 1.3% over 3 years for houses, best case scenario, down 25, base case down 44, worst case, that's over 3 years cumulative. And units down just a little, 0.9, base case down 18, 19, and the worst case down 31%. 31% are houses, 35% are units, 33% are other types of property. Population ratio is a lot lower at 1.59%, and vacancy rates were very high at 16.6%. At 1,268, so that could possibly be holiday accommodation or something else like that. Gross investment yield 4.1, net investment yield 0.6%. ATO average taxable $83,800. The household census $84,000, and monthly disposable incomes around $5,200, with 40% going on the mortgage at just over $2,000, and 28.9% or $1,495 going on the average rent. Okay, I've done that one. Okay, bit of a discussion there about various things. Thank you very much for all the super chats. Let's just put this one up. What's that one saying? Thank you very much, Jason, for the super chat. I really appreciate that. I'm not sure what the context is, but whatever it was, it sounds pretty good. And Nigel, I did that, I think, 8:20. I've already done that one, so thank you for the super chat. Really appreciate it. Really does help to cover some of the costs of what we do here. Okay, now what else have we got? Just remind you, please, to like the show. Let me just put that up while I remember. Please like and do subscribe. I do encourage you to please to subscribe on the channel. It really helps to get the count up and therefore the algorithms working for us. We do try and knock out some of the scammy comments in the chat on the main channel, which is an interesting operation in its own right. But it is important to try and spread the word and get more people to subscribe. So please share the information here. It would be very much appreciated as well. All right. What else have we got? Here's one. Tanner asked for 3196. Let's do that one. So this is Chelsea in Melbourne. Let's get rid of that. And one of the things you'll have noticed is that the model has more data in it now. I've basically got pretty much every postcode now, whereas previously some of the postcodes I excluded because the counts were too low. Well, I've been able to change that, so the model's more accurate. 11,500 households, 29% owning outright, 43% borrowing, 26% are renting, 65% in mortgage stress, 65% in rental stress, and 43% in financial stress overall. 9% fall over 3 years, best case, 33% base case, 52% worst case. That's on houses. For units, down 7, 24, and 38 over 3 years. Looking at the property profiles, 47% of houses, 24% of units, 28% of other types of property. Population ratio 2.16 and 6.9% or 811 properties vacant. 3% gross investment yield down into negative territory, minus 0.2% net investment yield on average there. Typical ATO is 81,000 in terms of taxable income, and typical household census was $95,200. Monthly disposable income on average around $6,129. The average rent is 32.2% or $1,972. The average mortgage is 40.7% at $2,496. Okay, Archie says Rockingham. Yeah, Rockingham could be quite interesting. Thank you for that. Let's have a look. 6168. 6168. All right. Rockingham, yep. We have Rockingham, 10,900 households. 32% own outright, 33% borrowing, 34% renting. We have 32% in mortgage stress, 62% in rental stress, and overall 38%. Scenarios are slight fall over the next 3 years, base case down 24, worst case down 43%. For houses, units down just a little, down 18, down 32 for the other scenarios. And we have 73% of houses, 9.6% of units, 17.2% other types of properties. The population ratio is 1.87 and 11.4% or 1,340 were vacant on census night. So that could be second homes or maybe holiday accommodation. 4.1% gross investment yield. Net investment yield down to 0.7%. Average taxable income, $74,900 from the ATO. Average household income from the census, $61,000. And the monthly disposable income, $3,956. The average mortgage, $1,728 a month at 43.7% of disposable income, and 37.8% for the rent, $1,495 a month. Okay, Kunal asks for Manly 4179. So I assume that's Queensland 4179. It's just started to rain very hard here. You can hear the rain rushing down. Into the nice weather again, so not good. Okay, 4179 Manly in Queensland. The count's 7,900 with 30% owning outright, 44% borrowing, 25% renting. The mortgage stress is 10%, the rental stress is 56%, and the overall financial stress 24%. In terms of price rises, best case scenario is 8% over the next 3 years, the base case down 15, the worst case down 34. Units, there aren't many of them, but 6, 11, positive 6, down 11, down 26 over the 3 scenarios. Then 79% of houses, 4.1% of units, 16.8 other types of property. Population ratios 2.45%, and the vacancy rates about 5% on census night, or 394, with a gross investment yield of 4.6%, a net investment yield of 1%, and the average taxable income 90,000, household census 108,000, and the disposable monthly income 6,621, with 38.5% going on the mortgage at $2,548 and 31.6% going on the rent at just over $2,900 a month. Now what I'm going to do is I'm just going to put the doggies up for a second because I need to just go and shut a couple of doors because the rain's coming in. Just 1 second. Sorry about that. I just needed to sort out my my doors. Otherwise, I was going to have rain absolutely everywhere, which would not be a good thing. Okay, what else have we got? Let's have a look. Jean asks for. Let's just move that over there so I can see it. Can't see whether there's a postcode attached. No, perhaps not. Okay, what else have we got? Lots of other requests. Burwood says Ballarat Evil. Yeah, we can do that. 3151. Gee, it's raining hard. It's not good. Okay, Burwood East. This is 4,200 in the house in the postcode, 42% own outright, 31% of borrowing, 26% of renting, and the 45% in mortgage stress, 50% in rental stress. Overall, households in financial stress, 32.6%. Looking at the scenarios, houses down 6.5% best case, down 30% base case, down 50% worst case. And the units, the best case is down 4.9%, 22% base, 35% worst case over 3 years. And looking at the profiles, 73% of houses, 8% of units, 18.3% of other types of property. The population ratio is 2.36%, 8% were vacant on census night, 351 properties. Gross investment yield 3.4, net investment yield 0.5. Taxable income $75,800. Household census income $83,700, and the monthly disposable income $5,225, with 49.3% or $2,576 a month, and that's horribly high. The average rent 41.9% at $2,189. Okay, Daniel T said 6065. Thank you for that. And thanks for the super set 6065. So that's tapping. That's another one on my list, of course. 24,000 in the postcode, with 19.1% owning outright, 63% borrowing, so it's a mortgage belt, 17.9% renting, 69.3% in mortgage stress, 73.3% in rental stress, and overall financial stress at 57%. The scenarios are down 4% over the next 3 years, best case down 28%, base case down 47%, worst case. And I won't do units because it's mostly houses. 92.4% are houses, 21,000. 7.4% other types. Population ratio is 2.73. The vacancies were just over 1,000 at 4.6%. And the gross investment yield is 3.8%. The net investment yield is 0.5%. Average taxable income, 78,800. The average household census was 110,000. And the monthly disposable income is around $6,900. 34.6% going on the mortgage at $2,400 and 28.8% or $1,993 going on the average rent. Okay, done that one. Have a look at 4560 somebody's asked for. Let's do that. Thanks for the super chat. 4560. Okay, 4560. This is Nambour, Brisbane and Moreton. And 14,600 households, 31% own outright, 43% borrowing, 25% renting, 50% in stress mortgage, 73% in stress rental, 45% overall in financial stress. Scenarios are best case scenario for our houses, most of them are houses here, up 1.7% over 3 years. The base case down 22%, the worst case down 42%. And the story is that 79% are houses, 15% are other types of property. The population ratio is 2.34%, 5.4% are vacant on census night or 790 properties. And the gross investment yield is 4.6, the net investment yield 1.3. Typical taxable income, $67,000 from the ATO. The household income on average $73,000 and the monthly disposable income $4,600 with 45.2% going on the mortgage at $2,080 and the average rent at 40.6% or $1,869. So there you go. That's another pretty sad story, I'm afraid. It does rather look to me as though it's sort of the story of the moment, isn't it? And there we go. I've got a few more to do, but I will just ease off for a second and just have a look at some of the other chat and see what other people are saying. If you want me to do, I need to post codes. I don't actually have the lookup for locations in the in this particular tool of mine. So if you can give me a postcode, I can give you the answer. And as I say, all of this information is available for those who are interested via the Patreon program. Andy said, interesting question. Have we seen central banks pivot in the last 24 hours? I don't think it's a pivot. To my mind, a pivot means they start cutting rates. All the RBA's done is just lift rates at a slightly lower pace, but they're still lifting rates. So to my mind, that doesn't warrant a pivot. But of course, the market's reacted because it was lower than what they expected, but we'll see. I did actually put a poll up, so be interested to see what you think. In the poll, you can say, I asked the question, do you think it was a pivot? Yes, no, I'm not sure. Be interested to see. So put your answers there and I'll report it at the end of the show, which is only 20 minutes away. Whew, it's gone quick, hasn't it? Let me just remind you again, please, if you have not done so, please subscribe to the channel. It really does help to spread the word and get the algorithm to work for us. I really appreciate those who do help to subscribe and support us what we do, because getting the word out is pretty important. I'm trying to help people understand what's really going on. And, of course, the anti-spook videos that Cookie helps me with are a very important part of that, because we're trying to tell the true story of what's happening with property rather than what the property sector would like you to believe. All right, now let's have a look. What else have we got here? Have I done that one? I'm not sure. Let's have a look. Yeah, I've done that one. Okay, so I've done Roselle. Let's Storm approaching Wollongong, you're right. It's Bondi Steve. Thank you, Steve. Yes, it came in a few moments ago, and boy, it was a storm. I couldn't understand what was going on. I could hear all the house creaking and the trees rushing around and all of the rain falling. Paul says the RBA will trash the currency and cause even more inflation. That's a risk, of course, and there's a bit of an interesting debate going on, isn't there, about which way they're going to do this. The problem, of course, is if you drop the currency, you import more inflation, like the cost of oil, for example. And we know that oil's a problem, not least because, of course, we're losing that excise holiday that we had, but also because so much of the economy is driven by the cost of oil for transportation. So it is... Yeah. Oh dear. Shane from the UK said, if you want to laugh, we put our house on the market in Hampshire, the UK, at the end of August. 2 viewings in a month, no offers yet, of course. Great timing. Yeah, it's pretty sad, isn't it? I'm afraid the UK is it's in a little bit of strife at the moment. I've been following that very closely. Daniel T said, I asked for 6050. Bummer. Now, what do you mean? You didn't want 6050 or you did want 6050? Let's have a look. Okay, I don't think I've done 6050, so let me do it. Or if I've done it, I'll do it again. But I don't think I have. Sorry about that. Okay, so this is Mount Lawley in the Stirling district, northwest Perth. 6,700 households, 30% own outright, 36% of borrowing, 32% of renting. There's really no stress to talk about, which is interesting. Bit of financial stress, but it's not particularly worrisome, I don't think. And that's really because the price scenarios are actually 1.6% over 3 months. 3 years. 1% over 1.6% over 3 years, down 22%, down 41%. And for the best case scenario, for units, up 1.2% over 3 years, down 16, down 31. 56% houses, just over 3,000, 25% of units, and 18% of other types of property. And the population ratio is 2.01, 9.8% were vacant at 694. Gross investment yield is 4.4, net investment yield 0.2. Average taxable, $123,000. Average household income, $108,000. And looking at the disposable income, down $6,600, with 43.2% of disposable going on the mortgage at $2,860. And there was 26.3%, or $1,745 going on the average rent. And the interesting observation here is I'm not quite sure why this is doing what it's doing. I may need to go check the modelling here because I'm not sure these numbers are totally correct, but it's the best I can do at the moment. Okay, Daily Fails says 3941, please. 3941, we can do. 3941. Okay, 3941 is Rye in Melbourne. 5639 households, 42% own outright, so that's one of the higher ones. 35% are borrowing, 22% are renting. 33% in mortgage stress, 80% in rental stress, 25% stressed investors, so that's overall 38%. And down 9% best case over 3 years, down 33% base case, down 53% worst case. I won't do units because there's hardly any units there. 95.6% of houses. Very low people count, so 1.06, so a lot of individuals, I suspect. And there were, 53.4% vacant on census night. Now, I'm not sure why that is. That could possibly be, I don't know what the location scenario is beach. It looks like it's holiday. It's probably holiday accommodation, so it may well be a lot of people away. So this might be slightly distorted because of that. Gross investment yields 3.3, net investment yield minus 0.1. Average ATO 70,000, average household 70,000. Monthly disposable income on average 4,393, with 49.2% going on the mortgage at 2,160 and 41% going on the rent. So that's the data that we've got on that one. Brian says 2780, please. 2780, here we come. Thank you, Brian. 6,400, this is Lura in the Central Tablelands. 38.9% own outright, 31% are borrowing, 29% are renting, 32% of borrowers in mortgage stress, 63% of renters in rental stress, and overall financial stress 31. The best case scenario down 5% over 3 years, the base case down 29, the worst case down 49, and units down 4, 21 and 35 over 3 years. 83% are houses, 9.4% are units, and 7.2% other types. And the vacancy rate was again very high, a lot of second homes and holiday homes, 1,300 in this area, I think. 3.4% and 0.4% on the gross and net investment yields. Average taxable income 75,000, average household income 64,000, and the disposable monthly income just over 4,000, with 51.8% going on the mortgage and 47% going on the rent. But because of this very high vacancy, you'd have to say it doesn't tell you the full story. Let's have a look. 3018. 3018. Okay, this is Altona in Victoria, 5,900, with 35% owning outright, 33% borrowing, 31% renting, 65% in mortgage stress, 31% in rental stress, 20% in investor stress, and overall 38%. Scenarios down 6, down 30, down 49 for best, base, and worst in houses. Units down 4, 21 and 37. And 63% are houses, 7.6% are units, 28% other. Population ratio is 2.12% and 8.2% or 502 are vacant. 3.3% gross investment returns minus 0.3% for net investment returns. 90,000 for ATO for the individual, 96,000 for the household, and the disposable income around $5,900 a month, with 44% going on the mortgage at 2,640 and 32% going on the rent at 1,944. Okay, here's one. 3024. Okay, 3024. 11,000 with 1,000 owning outright, 6,700 borrowing and 3,300 renting. 26% in mortgage stress, 87% in rental stress, and 46% overall. Down 8, down 31, down 50 for our scenarios for houses. I won't do units because 95% are houses. 2.92% population ratio and 5.6% or 625 vacant. 3.3% gross investment yield, 0.3 net investment yield. ATO average 70,000, household average 103,000. Monthly disposable income 6,274, with 34.4% going on the mortgage at 2,160 and 27.8% going on the rent at 1,745. And Andy says check 6110. Thank you for that, and thank you for the super chat. There we go, 6110. This is Huntingdale in Western Australia, 16,000. 20% own outright, 53% borrowing, 25.4% are renting, 40% and 30% respectively in disposable income. So that's quite high, which explains the high levels of stress, 39% and 71%. The scenarios are down 1.4, down 24, down 44 over the house scenarios. Very few units, so I'll just go with that. 89% are houses, 9.2% other types. Population ratios 2.59% and 5.9 or 957 were vacant on census night. 4.1% gross investment yield, 0.9% net investment yield. Average taxable income $72,000, average household income $84,000, and the average mortgage just over $2,000. The average rent just over $1,570. Okay, 2145, Mr. Blister. This is Greystanes in Sydney, 30,000 households, 20% own outright, 36% are borrowing, 43% are renting, 25% in mortgage stress, 57% in rental stress, and overall financial stress 45%. Scenarios are down 8%, down 31%, down 50% for the houses. For units, down 5, down 23, down 37. And there are 50% of houses, 29% units, and 19.2% other types of property. Population ratio is 2.64, and the vacancy rate's 8.5%. More than 2,600 properties shown as vacant on census night, 3.5%. Net investment yield 0.3, and looking at the taxable income, $77,000. Household census $108,000, and the disposable income $6,600 a month, with 40% or 2,687 going on the mortgage and 31.7 or 2,118 going on the rent. Okay, Daniel has asked for 2773. Okay, now that we're getting onto a relatively low count here, so just be a little bit cautious with these numbers, but basically we've got 44% owning outright, 42% borrowing, and 12% renting. High levels of mortgage stress, 90 and 74. This might be a bit overstated because of the low sample size here, but nevertheless the scenario is down 15, 40 or 59. It's houses, so that's where I'm going to stick. There's a population ratio of 2.63, and 4.7 or 103 were vacant, 3.5 for gross investment yield, 0.1 for net investment yield. Average taxable income $102,000, average household census $128,000, and average disposable income $7,778, with 38.6% or $3,000 going on the average mortgage and 30.8% going on the average rent at $2,392. Okay. What else? Nigel asked, do you factor in body, corporate and sinking funds when you look at apartments? Yeah, I try to get the total cost. Oh, whoops. Push the wrong button. Yeah, I do try to get the total costs, and that's why some of the analysis on the apartments is so interesting, particularly in terms of the real returns. Because, of course, you've got, when I look at the net investment yields, I'm taking account of all the various other elements. Now, when I look at the mortgage payment on units, I'm not counting those other corporate fees and things in those. I'm just taking the mortgage payment that is actually reported. And on the rent is the monthly rent that's paid. So if there are other fees in the top, you might not always catch it all. But when I do my gross and net investment yields, I do to try and catch it all. Okay, what else have we got? Victor says, can I explain the average taxable income number? Yeah, well, I can try. So there are two numbers, right? Let me just put this one back up again. There are two numbers. The first is the average taxable income. Now, this is reported in the ATO statistics. They report for every postcode the average taxable income. So that's the declared income that is actually declared on the tax forms by individuals. It's an average. And so that gives you a baseline per individual. And then the other one is from the household census. From the census, I can also derive the household gross income. That's 128,000. So often you'll see that the household income from the census is higher than the individual ATO because, of course, the taxable income is after offsets and things. So that's how it works. And that's what it means. Okay. Grum says, can I do 3199? Sure I can. Coming up to the last few minutes. 3199. Now I may well, whoops, I wish I could type. Okay. So 3199, here you go. This is Frankston in Melbourne, 23,348 households, 27% own outright, 39% borrowing, 32% of renting. I should just say, of course, these are the latest census data statistics. 63% in mortgage stress, 68% in rental stress, 51% overall. That, of course, is my own calculations based on my surveys. The scenarios are down 10, down 35, down 55 for houses. And as most are houses, 72 to 77% are houses, I won't do units. 2.19% for the people ratio, and the vacancy rate was 6.8, 1,617 on census night. 3.2% gross investment yield, net investment yield down 0.1%. Average taxable income, 73,000 for the ATO, 79,000 for the household census. And looking at the disposable monthly income, 5,298, with 41.8 on average going to the mortgage at 2,214 and 32.9% going on the average rent. Okay, how are we doing? There's a few chats there without any postcodes that I can see, so thank you for that. Sarwin says 2759. Certainly. Erskine Park, 8,800. 27% own outright, 51% are borrowing, 21% are renting, 79% in mortgage stress, 78% in rental stress. Overall household financial stress, 61%. Scenarios are down 14, 38 and 58 over 3 years for houses. 98% are actually houses in the postcode, and the people ratio is 2.98%, so it tends to be families. 2.8% vacant, 235, and 3.5% gross investment yield, 0.2%. Net investment yield, average taxable income, $72,000 from the ATO. Household census income, $110,000. And the monthly disposable, $6,521. That's from the census. And the repayments are 39.9% or $2,600 for the mortgage, and 33.6% or $2,193 for the rent. Okay, what else have we got? Yes, interesting. I agree. I don't know. I wonder if that super chat was meant to be a postcode. If it was, can you put the postcode in? Because I'm not quite sure what postcode we're going for. Hi, Maria. Welcome. Wonder whether you missed the hour change or whether you had something else on. Okay. Here's what. Whoops. Rowville 3178. Rowville 3178. Okay, this is Melbourne, of course. 12,000 households, 33% own outright, 50% borrowing, 15% renting, 84% in mortgage stress, 77% in rental stress, 55% in financial stress. 12, 36, 55 scenarios, all negative for houses. 91% of houses, and 2.76 is the ratio. 4% for vacant, 471. Gross investment yield 3.1, net investment yield minus 0.3%. And the average individual, 77%. The average household, 114,000. And the monthly disposable around 7,000, with 34% going on the mortgage at 2,466 and 30.9% going on the rent at 2,198. Okay. $3099 postcode, same as donation. Okay, 3099 it is then. Thank you for that. Now, I must tell you that my little low count warning has come up here, and that basically says because the count is very low, it could well be inaccurate. So we have to be careful with these low counts. I have a 0.5% sample, and that means that on very low counts, it may not be that accurate. Never mind. We can certainly say that 36% own outright, 53% are borrowing, and 10% are renting. Looks as though about 41% are in mortgage stress, and there's a high proportion in rental stress. We think that the scenarios are down 11, 35, and 55 for houses, and most of them were houses, 97%, so I won't bother with units. 2.62%, the people ratio, 6% were vacant, 120. Gross investment yield about 3.5%, net investment yield about 0.3. Average taxable, $82,000 from the ATO. Average household income, $112,000. Disposable income, somewhere around $6,700, with 36% going on the rent, $2,400, and 28.9%, $1,948 going on the rent. The other one was going on the mortgage, of course. And thank you very much for that super chat. Really appreciate it. Let's put that up. Thank you for that. Thank you. I do appreciate. We've done that again. I keep pushing the wrong button. There we are. We've pushed the right button. We'll get into it. And thank you very much for that super chat too. I really appreciate all the super chats. They do really help to cover some of the costs. So thank you for that. Now, what else have I got? 4818. 4818. All right, let's do that one. 4818. I'm going to run out of smoke soon, so just bear that in mind that I won't be able to do all of them. This is Bushland Beach in the Northern District of Queensland. 11,300 with 14.7% owning outright, 52% borrowing, 33% renting, 55% in mortgage stress, 28% in rental stress, overall financial stress, 40%, 8% positive over 3 years, best case 16 down or 36 down for houses, and as it's mostly houses, 95.9% I won't do units, 2.59%, and the vacancy rate 6.9% at 788 or 4.4 gross, 1.3 net. Taxable income $76,000, $107,000 from the census data per household, and the disposable monthly income around $6,700, with 30% going on the mortgage, just over $2,000, and 26% going on the rent. And there you go. That's pretty much where we're going to get to, I think. Jason, thank you very much for the super chat there. Really appreciate it. And stay well. Interesting times indeed. Yes, I agree with that. Yeah. Cheerio, Vanessa. Thank you very much. See you next time. And okay, so Stephen says, can you please tell me again what the scenarios are based on? Yes, I can. So let me put this back up. So this is the best scenario is that interest rates stay, this is the cash rate, below 2.5% and fall next year, and inflation eases ahead of RBA expectations while wages rise faster. There's no recession. The base case is that rates rise to about 3.5%, which means that mortgage rates go 6-7%, stay high in 2023, while inflation stays above target until 2024. That's the RBA target. No recession in Australia. And the worst case is that rates stay above 4%, which means mortgage rates are about 7% or more. They stay high into 2024 along with inflation and wages. We get a recession because wages growth stalls and recession happens, and rates fall later. So those are, in essence, there's a lot more multi-dimensional stuff below it, because I think of things like migration and all those other elements and wages growth and those things. But those are the key variables, because essentially it's all about what interest rates do. So I hope that helps. Okay, well, we're well after 9:30. Let me just see, is there anyone that I need to do and haven't done? Yeah, I missed that. There we go. Okay. Yep. Okay, so Cookie says, next anti-spook video. Yep, there are more anti-spook videos coming. Cookie's swamping me with data at the moment, but I've got some up in Sunshine Coast and a few other places too to look at. Some of them are looking pretty sick, actually, and we will get to that as soon as we can. Brendan says, thanks always. Hammers and Hammer says, when island-style crash? I'm not sure. It depends on what the question is interest rates, right? If the RBA does pivot, if they do pivot, we might get away with not having a crash. If rates go on going higher, as it's quite likely that they will, we will get some sort of crash, and then it depends on how high and how far interest rates go. Any New Logic asked, any update on the website changes? So do you mean the DFA portal? Yes, there's some work on it at the moment, trying to get rid of a couple of technical issues. So what I'm doing at the moment for those on Patreon is I'm sending out the full spreadsheets so people can get all the information. You can still actually get into the Patreon program and through that into the portal, but you just have to sort of duck and weave a bit because the security settings need to be sorted out, and I'm waiting for the guys to finish the security changes. So that's the story on that. Okay, Katie Plummer says, no Armageddon listed on your scenarios. No, I just do the three. Look, there's always more you could do, right? But what I'm trying to show in my scenarios is the sensitivity to interest rates, because that's the critical thing that people need to understand. And we will see. Nigel Fox says, thanks for your amazing hard work. Well, I'm glad to help. And Keisha says that worst scenario is still pretty mild. Well, it probably is, but, you know, I mean, I could say, yeah, probabilities drop 80%, but really, I suspect that we'll get intervention from the RBA before that happens. Anyway, that's just the way I've chosen to do it. And as Tribe says, please like the show and make sure that it's subscribed and shared. And Steve says, how long does ANZ take to approve? They're actually quite fast at the moment because they've updated a lot of their systems and processes. Should be just a few days. Okay, now let me think. What else do I need to do before I finish? Oh, yeah, we should just go back over here a second. Yes. Now, so just to remind you, if you do want to get hold of all this data, you can subscribe via Patreon, and it's $50 US a month plus GST. And you can then subscribe and receive every month the full data set that I've been going through this evening. It's updated every month. And for as long as you subscribe, we send that data set out to you, and also gives you access to the online version as well, which is, as I mentioned, just being tweaked a little bit at the moment. I also, if you'd like to make a donation to help me out, there's obviously a PayPal option as well, which is always greatly appreciated. Now, in terms of the poll, we mustn't forget the poll. Of course, I spent all this time setting it up. So what did the poll say? So we said, RBA lifted 0.25% today. Does this represent a pivot? And 27% of people said yes. 55% said no. And 18% said unsure. So that's pretty much, there's a bit of sort of variety there, but actually the majority said no, it's not a pivot yet, and that tends to be what I think. So I've ended the poll now, and put that 4570 bloke out of his misery. Okay, let's do one more. 4570. There you go. If you're still with me now, you deserve 4570. 18,000. This is Mother Mountain in Y Bay Burnett. 39% own outright, 38% borrowing, 22% of renting, 20% in stress, 88% rental stress, and 3.8% positive over the next 3 years, best case scenario. Base case down 19, worst case down 39, and 92% to houses, so on others are units, 2.2% ratio, and 9.1% vacant, so 1,760 on census night. Gross investment yields 4.5%, net investment yields 1.3%, average taxable 64,900, average household census data 60,000, and disposable around $3,831, with 40.7% going on the mortgage at 1,560, and 38% going on the average rent at 1,470. Right. And yeah, there are some quite significant changes, of course, with what's been going on over the last little while. And as I said before, I have also updated the census data as well in recent days as well. Okay, I think I'm pretty much there now. Now, just before I go, let me just do this, and that is to say that, whoops, next week we're going to be talking economics, and Leith Van Onselen is coming on to talk about all things economic, and very relevant, of course, given what's happened today. So mark your diary for that. And if I may just remind you once again that two or three rather important things. If you have difficulty with finances, and if you've got issue with cash flow and all those things, it's worth bearing in mind that the National Debt Hotline on 1-800-007-007 is always there. That's a free consultation line. It's run by the government, and it's not one where they charge you to provide advice. That's worth bearing in mind. 1-800-007-007. Also bear in mind that if you do have financial hardship and you're paying a mortgage, the banks are obliged to talk with you and try and help you out. So that's that. Another one's come in. Dear oh dear, we can't keep a good query down, can we? 2607. Okay, this is the last one. I'm not going to do any more because I'm 2607, which is Torrens in Canberra. Ah, good. Canberra won 5,900. 36% earning outright. Let's put that up. Torrens in Canberra, 36% own outright, 38% borrowing, 25% of renting, 17.6%. Rentals in rental stress, 75%. Overall financial stress at 36%. A bit of a scenario with down 5, down 29, down 48 for houses, and down 4, 21, and 36 for units. 70% of houses, 8.7% of units, 2.36% population ratio, 4.5% for the gross investment yield, 1.1% net investment yield, average taxable, $100,000 plus, average household from the census, $125,736 per annum, monthly disposable, $7,438, typical mortgage, 38.4% or $2,860, typical rent, 29.5% or $2,193. Okay, that'll do. That's as much as I can do tonight. Now, if you sent me a request and I didn't have a chance to answer it, there is another way for you to get the information. And that is if you send me an email, and you can do that via the DFA blog. If you go onto the DFA blog, you can actually send me a message directly. And if you do that, I'll pick it up. And over the next few days, I'll send you back one postcode. I'm not going to send lots of postcodes, but if you've got one postcode. So if you missed out and you still want data, that's a way of doing it. Or, as I said earlier on, if you want to subscribe to get the Patreon system, which is the whole data set for all postcodes, that is all possible. And then the other thing I'm going to do is just to remind you again, as I mentioned earlier on, those 3 quick requests when it comes to, whoops. So if you haven't signed up for the petition relating to regional bank closures, I'd love you to do that. That would really help us get Chalmers to respond. On 19th of October, the Walk the World Nucleus Wealth Macro Business event down in Melbourne. And on the 9th of October, from 10 a.m, Harry Dent, Robert Kiyosaki, Peter Schiff, Gerald Salenti, and myself, hosted by Greg Owen. So that could be quite an interesting session. Anyway, with that, I want to say thank you very much for spending some time on your Tuesday evening with me. Really appreciated it. And thanks for all the questions and all of the postcodes. I'm sorry I didn't get to all of them, but, there was just so many. One last view of the dogs, who are still sound asleep. They have not moved. So there you go. Dogs, I think, had the better end of the stick, but that's okay. And so I wish you all the best. Do check out our other recorded shows over the next few days, and we'll be back next Tuesday for another live show. Take care. Have a good evening. See you soon. This is Martin North from Digital Finance Analytics, signing off. Cheerio.